What's up, guys? Welcome to another Market Radar podcast. We are recording this one on Thursday, February 2nd, the day after the massive Nazi noodle rip, now up 17.86% year to date. An absolute killer rally since FOMC. Let's talk about next week. What do we have going on? It's a pretty slow week. We do have jobless claims on Thursday. That's the main thing we'll be looking at. But other than that, nothing too crazy going on. We've got some Fed speakers, but that's about it. After FOMC, the market had a massive rally, especially the NASDAQ, but ES as well, because Powell basically came out and was signaling that deflation is coming. He was saying their data is looking disinflationary and they can slow the pace of hikes, which, we already knew, we already expected that, but it's funny to see how the thought of deflation being around the corner is bullish for equities. It's kind of funny because deflation is usually what occurs during major recessions. That's the recessionary pivot. So what do you think about that, Gamma?
That's a good way to put it. Obviously, deflation is the recessionary pivot, but I think the market's been very hypersensitive to interest rates, right? So everyone's concerned about where the terminal rate from the Federal Reserve is going or going to be, right? And as that goes higher, the market has pretty much traded inversely to that. And as we saw a peak in the terminal last 3 or 4 months, and it's steadily come in, the market has been off its lows and slowly grinded higher. So I think that at least in the short term, there's a correlation there to the terminal rate and or the direction of the terminal rate and the direction of the market as a whole. But yeah,
this is actually a good lesson for those that are new to macro and doing this kind of analysis. You got to realize everything is very fluid. It's always relative. It's not just like, okay, rates up is bad, rates down is good. It's very relative. So like deflation is bad. No, it's not always bad. You got to take everything into account. What's the scenario? Okay, if deflation means that rates are not going up anymore, depending where equities are, if they have been pricing in higher rates and expectations for more inflation, they're going to be rallying on the idea that rates don't have to go as high as they thought they would. So keep that in mind. Everything is always relative. Everything is always fluid. You can't just have this binary linear thinking as you go through the market, and you got to really adapt to new information that comes in. And
yeah,
that's what our system is so good at doing. It takes a lot of the legwork out of that, but we do have to do our own analysis to accompany the system as well.
Yeah, we call those people linear economists. What they do is they reference something real simple and they try and extrapolate it in a straight line and say, just because this happened in the last 3 sessions, or I should say the last 3 times, it's a guarantee that it's going to happen again. And it's usually not something very complex. For example, it's looking at inflation and saying inflationary peaks. Once they peak, they fall off a cliff. It's a different time right now. Inflation's obviously sticky, right? And that's another thing. This deflation, right? Which is what disinflation is. If you have inflation at 6.5% year over year, and you go down to 3%, which is what the average is, what everyone wants to see, right? A 3% inflation number, that's deflationary. But that's not deflationary as a recession, if you understand the real economic cycle, because it's really when the inflation rate falls off from 3% and lower where things really get problematic.
Right. And
so
we have yet to see that, but that
right.
would be the bond trade.
Right. So the bond trade will come most likely well before the rates do get down to the 3% area. But just remember, rates were rising the whole COVID rally, or a good part of the COVID rally. Rates were going up.
Right.
And now all of a sudden, rates became an issue, just magically. And we can do some real simple here. For example, let's overlay the 2-year yield. You'll see exactly what I mean. Here. Rates going up, going up, going up, going up. And at a certain point, they became an issue. Right. It was at a certain point, things became problematic. And this is because essentially rates going up, inflation going up, and we can even look at inflation. Let's look at that. That's an even we use rates as a proxy for inflation, but if you really look at inflation, inflation started accelerating way before rates. Rates are so. This also brings up another topic that it's a very shallow one, but it's something that no one understands. Most people think the bond market controls the Fed. It's the other way around. The Fed controls the bond market, and you can see that here, right? So we have inflation ripping. Okay, inflation was already in the high fives, while the 2-year was still at zero, pretty much. Okay, so inflation was already getting way above trend. Now the 2-year didn't move because they didn't think, or the bond market didn't think the Fed was going to move soon. It's when they think that the Fed is going to start to move that the bond market starts to move, not the other way around. The bond market's not going to force the hand on the Fed, because if that was the case, if the bond market was going to force the Fed's hand, bonds would have been moving way earlier to force the Fed's hand. But if we take a look at and we type in the EFFR, we put that on the chart, you'll see it's not it's a front run, but it's not a correlation to interest rates. It's more of front running the Fed. The Fed's going to hike soon, right? And which they did. But if the bond market was really in control, why did it take so long for it to start lifting? It could have lifted well. CPI started bouncing in July of 2020. So for the 2-year to start accelerating in 2021, almost over a year later,
Right.
Obviously,
there was some sort of hint that the Fed was going to start hiking rates. That's when
exactly
bonds started to really move. Now, speaking of bonds, let's talk about what bonds did after FOMC. It's very interesting.
Yeah. So this was FOMC day right here. Okay, and you see bonds. Excuse me. No, I'm sorry. This was FOMC day right here.
Right.
Right. Yeah. So bonds rip. Right. Nice rip. Seems nice. Just reminder, we're in bearish trend.
That was due to Powell coming out and basically hinting that what they're seeing is disinflation, inflation peaking. So he really pumped up bonds by saying that.
Yeah. So what Powell, that's a good point. So what Powell basically said was this. Powell basically said that a soft landing is possible. They'll be able to get rates down without a recession. Okay. Bonds, obviously, lower rates. They're going to like that. Bonds are going to go up. The problem is the continuation here is so lackluster. So lackluster. For example, let's look at the S&P, right? Let's clear this. Let's clear all this nonsense here, and let's look at just the pure S&P, right? This is FOMC day right here. And we're continuing. We're taking out the December highs, right? We're going up. Let's look at bonds. Bonds can barely get above the December high, the November highs, excuse me. We're still struggling around the November highs. And if the market truly believed that inflation has a peak that is confirmed, bonds would be higher than now, because obviously they know that inflation is going to fade off and we're going to get rate cuts at some point. So bonds are going to move higher because the rate environment is going to improve for the bond space. But there's a reason why bonds aren't moving. And bonds are not stupid money. They're much smarter than equities. So something's going on here. And what I think is going on, the bond market's seeing some uncertainty around the inflation narrative, saying that there's still some inflationary risks on the table, whatever they may be. We might not see them yet, but the bond market is still nervous. Now, the equity market is taking off, and you can take this one of two ways. The equity market believes that the Fed can achieve this soft landing, right? So, as Powell has said, Powell basically laid out that he thinks that the economy can return to normal without a big downturn or a jobless jump. That's a soft landing, right? A huge unemployment spike.
Mm-hmm.
The problem is the market's believing this. Okay, the market also doesn't mind the fact that inflation is falling. Now, it's when inflation is rising and hitting new highs that things just start falling apart all over the place. But even if the prints are lower by 20 basis points every time, lower is better over the long term. The market will basically create a linear model within itself and say, okay, inflation's peaked, it's going to go down, it'll trend down, so we can play the game, we can bid risk assets, right? Okay, it's not deflationary to the point where it's a recession. Remember, just getting back down to 3 is not really a recession. Like inflation is still prominent. Okay, it's not as prominent at 6, but it's still obviously
Right.
positive.
And it's not negative. Negative would be
Exactly.
a full blown
And that's
recession.
hardcore. That's hardcore deflation. But we can see deflationary cycles in markets, obviously, without that negative print. But yeah, negative inflationary print, that's hardcore recessions. That's hard, like there's no debating that.
Right.
But yeah, long story short, the market's looking at the situation as follows. It's saying, okay, soft landing is possible. Number one. Number two, rates are going to progressively get better, but obviously we know they're way out of bounds, right? Rates are still extremely high. So when you look at the regime cycle, you might say, and we do have some people on Twitter that say this. Well, look, the rate of inflation CPI is falling. You're CPI is rolling over. What's going on? You have to understand where CPI is in the dynamic of history. It's still extremely high. So the market is picking that up as think of it like an out of bounds inflationary thing, inflationary indicator. Just like when we had high inflation and and very poor growth, it was an out of bound that stagflationary regime was so out of bounds. It's something the market hasn't seen in 10 or 20 or more than 20 years. So it was such a powerful setup in the market because no one was prepared for that stagflationary event because no one has seen something like that happen in recent times. And if we go back to the current situation where inflation is still well above trend, you have to understand that the way the market's going to react is not so tit for tat. Things are going to be very different. Things are always changing. It's a stock market. Nothing is linear. That's why we pick on linear economists because you can't look. You can have a base model, but you have to work around it. Now, the end result should be definite, yes or no. But the process to get to that yes or no, that long bonds, long equities, long risk, long risk assets, short risk assets type of model where you get that definitive result needs to be built on many checks and balances along the way that are dynamically adjusted across time, where as time progresses, those qualifiers shift. So you're not ending up in a situation where you are putting your portfolio in a position on something that is so linear that it can basically get outdated by changes in the market.
Right. Yeah. And that's where a lot of these macroeconomists fall into a trap.
Yeah, and we see it all the time. Honestly, you go on Twitter, you'll find so many. Right now, obviously the market's up, so you got the bull camp, the people that say ES is going to 4,700s, 4,800s, new all-time highs on the way, and then you have the bears. Just Michael Burry, for example, day before FOMC says sell, and
Yeah.
his Twitter account just went into thin
Well,
air.
let's talk
Vanished.
about where we expect equities to go. So, bottom line, we're obviously in an inflationary environment, high inflation. It all depends on growth, whether this rally continues or not. It all
That's true.
depends on the underlying. You have expansion and you have inflation. Those are the two risk on regimes. For equities to continue higher, growth needs to be positive for both of those regimes. Whether inflation comes down or remains high doesn't really matter too much as long as growth can stay elevated.
Yes, that's a good point. So even if the market does start picking up on that idea that things are really more deflation or disinflationary, right? So like CPI is really falling, the market starts picking that up, and it's no longer that far out of bounds. It doesn't mean the market is going into a recession because the growth factor is the real nail in the coffin there. Positive growth environments change the game completely. They really do. You
Right.
know,
And that's, I
anything.
think, a trap that a lot of the people waiting for the bond trade, waiting for that long bond trade, deflation, all that, they're going to fall into that trap of thinking, okay, deflation's here, inflation's going down, right? It's time to long bonds. But what they don't
Yeah.
realize is if growth is still there, it's not the bond play, it's the equity play that you should be in.
Yes, and the pro see the another thing that comes from this is when your models and your theory, right, behind what you're doing is based on lagging data or right a narrative. And we speak about this a lot lately because this is what's screwing a lot of people over, the death of a narrative. And a good way to put this is everyone that's long bonds is long bonds because of two things. They don't think the Federal Reserve can hold rates up here for long, and they think that this is a good a reward or a good coupon payment at in the current environment, right? It's 4%, 3.5, whatever it is. I think we're looking at like 3.5 on tens, right? What do we got here? Tens are like 3.3. So excuse me, 3.37s on tens, right? 3.5s on 30s. They think those are good coupons. So that's two reasons why you'd be long bonds. The problem is those become good coupons if you think they're going to be less dramatically in the short term, or at least in the next 6 to 12 months, right? If you think that 3.5 is a great coupon, well, if the market can't provide more than 3.5%, it is a great coupon. But if there's no recession coming, the market, the Nasy's up 18% year to date. You really can't argue with me about 3.5%.
Right. I mean, you can you can make a few years worth of gains off of just the
In
last
one
day.
month. In what? Yeah, or yeah, in the last 2 days, right?
Yeah.
Um, and the issue is the bond trade is reliant on the rates trade, and because obviously the bond prices are going to rise as rates fall, and for rates to fall dramatically, you need a reason for the Fed to cut them, which would be a recession.
Right.
To get a recession, you need a negative growth environment, because without that, like we just said, inflation can fall. And the thing is if inflation falls far enough, eventually it does affect growth. So it's not like inflation will go negative on a hardcore negative year over year percentage change, and growth will just be sky high and just chugging along. That's not how that works. Eventually, in the inflationary pressure or the lack of um, demand pressure that comes with a high inflationary environment becomes obviously inverse, and then that affects the growth of the whole economy, and then there and so forth, you end up in a recession. So you have to watch what's going on. The bond people are specifically looking for the recession. The equity people are looking for the Fed to pivot. And what they are both looking at, unfortunately, is they're looking for a recession. So the bond people will win that argument. The equity people that get so cheerful about the Fed pivoting, well, the only time the Fed's going to really pivot, a true pivot, is going to be because they need to stimulate the economy because of a recession.
Right.
Right?
And
So,
so but at the end of the day, we both agree that we will get deflation eventually. I mean, you don't get a yield curve this inverted and not get a recession.
right.
It's
No,
going to
I agree.
happen,
Yeah,
but
I agree.
that doesn't mean it's going to happen right now. It could,
That's the scary part, right?
yeah, it could take a year. It's not about if, it's about the when. And a lot of people are going to get the timing wrong, and they're going to lose a lot of money. We're not going to,
Yeah.
though, because we got the system.
Yeah. And Aries. Well, Aries obviously has built up the system, right? So we got Aries.
Yeah.
But yeah, dude, that's a great way to put it, because unfortunately, a lot of people think, with, like I said earlier, the death by narratives is too much emotion. You look at the market and you're sold on this idea. You're sold on this belief that, okay, we can't get a bull market, or we can't get a recession right now because unemployment is so low, right? And then we can't get a bull market because we're going to get a recession. These are just two alternating opinions. But you get my point, where people will dig themselves into a hole beyond the point of where they can see anything around them, and they're just sitting in darkness, and they're just waiting for the next news bite headline that feeds their urge to dig themselves deeper and deeper, and then eventually you're done, you're gone, you're a perma bear or you're a perma bull, and they're both lethal. Buying, just averaging down, and then when you run out of money, saying, you know what, it's time to use margin because we're going to go back, and then you're bankrupt. So perma bears, they short to heavens, and perma bulls, they buy to the hells, and they end up both in the same boat of being screwed, because neither of them tend to last or persevere the entire curvature of the move, where at some point there's a max pain point, and the smart money is able to get over that and ride the wave, and the perma bears and bulls, that's where they're washed out.